Very happy to notify that we have received the ATG approval for the CGPI. For many people, it is just a certificate. For us, it is another milestone. As we committedly try to build an institution of excellence, an association grows into an institution based on its sterling work, recognition it achieves, and the difference it makes to the members and patrons. So ATG registration is another step towards establishing our presence and our credibility. Series of, on account of the burning issues that we have planned, are essentially derived because with the 5 years of GST, we have seen multiple circulars, notifications, clarifications issued, and the challenges faced by almost all of us to handle this particular aspects. And with keeping that view in our mind, we have established this series and we are inviting multiple speakers to speak and deliberate for us. Before I proceed to hand over the charge of introduction, I would like to say one more thing. We are planning a residential refresher course at Pune from 4th November to 6th November. I would urge everyone to attend the same, where we have planned the topics which are of the current interest to everyone. And I think whoever will attend such a RRC program, they would be benefited. With this, I would request our committee team member, Saurabh Jain, to introduce the speaker for the day, CA Tushar Aggarwal. Thank you, everyone.
Thank you so much, sir, for allowing this wonderful task of introducing our learned speaker, Shri Tushar Aggarwal ji. So it is quite a long profile before me, since he is having really a very enriching experience. So Mr. Tushar Aggarwal has more than 10 years of experience in indirect tax. He has worked for more than 8 years with Lakshmi Kumaran and Sridharan attorneys. He was also deployed by Goods and Services Tax Network for GST implementation and has worked closely with government officials. He has worked extensively with the Government of India in GST designing of GST returns, audits, and other formats. He is a member of ICAI, having held all India merit positions at all stages of the CA curriculum. Mr. Tushar specializing in advising clients on complex IDT issues, structuring business operations, identifying and advising tax efficient business models, contract reviews, cross-border structuring, as well as structuring of business transfers, joint ventures and foreign investments, and whatnot. He has also been involved extensively in conducting tax compliance reviews, GST audits, etc. He has handled multiple GST transitions and implementation projects, post-implementation review projects, transition planning, training, registrations, preparation of procedures and policy, and filing of returns, business and financial impact assessments, revaluation and finalization of optimum business models. He has been involved deeply with real estate, hospitality, aviation, infrastructure sector, manufacturing sector, etc. I think nothing is left over by Shri Tusharji. He has been an active member of various trade associations such as PhD Chambers of Commerce, CREDAI, etc. And he is actively involved in taking up the issues on various industries with governmental authorities. Shri Tusharji has been an active speaker at various national and international seminars, reputed workshops and conferences organized on indirect taxation. He also has many research papers and articles in the reputed national and international journals and publications to his credit. So really a very wonderful task for me today to introduce the learned and very energetic speaker of the day, Shri Tushar Aggarwal ji. So Tushar ji, we heartily welcome to the CGPI platform, and and we will request you to kindly enlighten the house, which is having distinguished participants across the nation, with your words of wisdom over an interesting issue of the interest under GST. Over to you, Tusharji. Thank you.
Thank you so much, Saurabhai, for your kind words. At the outset, I would like to thank CGPI, Nitin Bhai, Rinav Bhai, everyone for giving me this opportunity. Thank you to all the participants for joining. So let me just share the screen before we proceed. Good evening to all the friends. Friends, in next 60 minutes, we will be covering an in-depth analysis of the interest provision under the GST law. So the flow of our presentation will be in form of case studies. We have taken 12 different case studies, 12 different life situations, which is being faced by all the tax professionals, all the taxpayers, and we will study each and every case study along with the relevant section and rules. The first case study will be in respect of late filing of returns. The second will be in respect of omission of invoice in returns. Third, ITC wrongly availed and then reversed before utilization or after utilization. And the fourth is balance lying in cash ledger. If you have a balance in your cash ledger, still whether the interest can be demanded. So these initial case studies, these may be some of the transactions which we are dealing on daily basis, will help us in understanding Section 50 and Rule 88B in depth. And thereafter, we will drill down into more interesting case studies related to, say, interest on erroneous refund, reversal of ITC owing to failure of payment within 180 days, interest on wrong regional credit, etc. So in these case studies, we will drill down into Section 50, see how Section 50 is worded, what power government has. In last couple of months, we have seen that lot of notices have been issued to the taxpayers in respect of recovery of refunds or transitional credit issues or related to 180 days payment, etc. So all these case studies will help us in understanding how Section 50 and Rule 88B has been drafted and whether the government has power to recover interest in all these scenarios and what are the arguments which we have to take while making our replies, which we are submitting before the adjudication authority. Apart from that, we will also drill down into some of the case studies wherein I am eligible to get the refund from the department. That is interest on delayed refunds and interest on pre-deposit. So let us start our session with the first case study on late filing of return. I will give an example. Let's suppose in the July month, my tax liability is 1 lakh rupees and my ITC for the month of July is 40,000 rupees. 60,000 is which I have to deposit from the cash ledger. Due date of the return is 20th of August, but I have filed my actual 3B on 24th August. The first issue under consideration is on what value interest will be leviable for the delay in filing of return for 4 days, whether interest has to be paid on 60,000 or interest has to be paid on 1 lakh rupees. So let us read the law together. The purpose of all these initial case studies is to understand Section 50 and Rule 88B in depth. Only once we understand, because there are limited section and rules when we talk about the interest provision and all other case studies, which we will drill down in the later part of our presentation, everything will boil down to this Section 50 and Rule 88B. So I want all the audience that please read this section along with me so that we all are on the same page and interpret together. Section 50, subsection 1. Every person who is liable to pay tax in accordance with the provision of this act or rules made thereunder, but fails to pay the tax or any part thereof to the government within the prescribed period, shall for the period for which tax remains unpaid, pay on his own interest at such rate not exceeding 18%. So the first Section 50, subsection 1 talks about payment of interest wherein the taxpayer fails to pay the tax amount to the government. So where he has failed to pay the tax amount, he is liable to pay interest. And then we have a proviso to Section 50, subsection 1, which was substituted by Finance Act 2021 and which is effective from 1st July 2017. It says, provided that the interest on the tax payable in respect of supplies made during a tax period and declared in the return for the said period, furnished after the due date in accordance with the provision of Section 39, except where such return is furnished after commencement of proceeding under section 73 or 74 shall be levied on the portion of the tax that is paid by debiting the electronic cash ledger. So provided to section 50 subsection 1 deals with a situation wherein there is a delay in filing of return, and there is a delay in filing of return, and you are in that situation, you have to deposit the interest only on that portion of tax that is paid by debiting the electronic cash ledger. Apart from this, we have Rule 88B, which is also effective from 1st July 2017. So let's read Rule 88B, Sub Rule 1. In case where the supplies made during a tax period are declared by the registered person in the return for the said period, and the said return is furnished after due date in accordance with the provision of section 39, except where such return is furnished after the commencement of proceeding under section 73 or 74, interest again will be leviable only on that portion of tax which is paid by debiting the cash ledger, worded in a very similar manner the way section 50 subsection 1 is worded. So this section 50 proviso to section 50 subsection 1 read with this rule 88B1. It is clear that the law itself says that in this situation, the interest has to be paid only on the amount of tax which is paid by debiting the cash ledger, that is 60,000 rupees. So interest will be calculated on 60,000 rupees only. But there is an exception to it. The exception is if you are filing your return after receiving the notice under section 73 or 74, what will be the situation? Proviso to section 50 subsection 1 specifically says, except where such return is furnished after commencement of proceeding under section 73 or 74. So what do you mean by commencement of proceeding? If you get a normal scrutiny notice or a general notice about non-payment of non-filing of returns, etc., does it mean there is a commencement of proceeding under section 73 or 74? Or there is a search, seizure, inspection, etc., and there the anti-evasion team, the jurisdiction team, or any other team pinpoint that the returns has not been furnished. Can we say there is a commencement of proceeding under section 73 or 74? To my mind, commencement of proceeding under section 73 or 74 means issuance of show cause notice under 73 and 74. So until and unless there is a show cause notice which is issued under section 73 or 74, we cannot say that the proceedings have been commenced under section 73 or 74. Accordingly, before issuance of show cause notice, if you file your return, the tax has to be paid only on 60,000 rupees and not 1 lakh rupees. Moving on to the second case study. Let's take an example. My invoice date is 15th July 2022. Tax liability is 1 lakh rupees, and I'm supposed to file report this invoice in my July month return only and file my return by 20th of August. But I have missed that. I have not filed. And say I will be filing that in October. I will be reporting that in October 2022. The issue is, what will be the implication of interest in this case when I'm reporting this invoice in the month of October 2022? Will I have to pay interest from 20th of August, 21st of August till my due date of furnishing of October month return, whether interest will be payable for the entire period or not, irrespective of the fact that I have my ITC balance lying in my ledger. So I have my ITC balance of say 2 lakh rupees, which is still lying in my ledger, and there is a omission or invoice. Can I argue and say that since I was already having cash ITC balance lying in my electronic credit ledger, but I have missed this invoice to be reported in July month, I'm reporting it in subsequent months in October, there is no loss to the exchequer. I could have paid it through credit. Accordingly, I'm not liable to pay any interest. Can that argument be taken? So let me take you to this agenda of 31st GST Council meeting. What does this agenda says? It says that the committee observed that the proposal to charge interest only on the net liability of the taxpayers after taking into account the admissible credit may be accepted in principle. Accordingly, the interest would be charged on the delayed payment of the amount payable through electronic cash ledger. However, very important to note, where the invoices, debit notes have been uploaded in statements pertaining to the period subsequent to the period in which they have been uploaded, the interest shall be calculated on the amount of tax calculated on the taxable value from the date on which the tax on such invoices was due. This would require amendment to the law. So when we see the agenda of the 31st GST Council meeting, the intent of the government is very clear that the interest has to be paid from 21st of August in our example, when this tax amount become due. And when we see the correspondingly rule, sub rule 2. So the sub rule 1, what we discussed was only catering to a single situation of delay in filing of return. How interest will be charged in case you are filing your return on delayed basis. Sub rule 1 cater to that situation only. What does sub rule 2 says? In all other cases where interest is payable in accordance with subsection 1 of section 50, the interest shall be calculated on the amount of tax which remains unpaid for the period starting from the date on which tax was due to be paid till the date such tax is paid. So sub rule 2 specifically says that in all other cases, you have to pay tax from the date when such tax interest from the date when such tax amount become due. So in our example, I have to pay interest from 21st of August till the date I'm reporting this in my future return period. So interest will be levied irrespective of whether you have any balance lying in your ledger or not. So after discussing these case 2 studies, we have overall understood the concept of section 50 subsection 1 and rule 88B sub rule 1 and 2. The next 2 case studies relates to input tax credit. By virtue of this case study, we will be understanding what does section 50 subsection 3 says and what does rule 88B sub rule 3 says. And we will try to understand that section and rule together with the help of this case study. I have taken ITC of 5 lakh rupees, which was an ineligible credit, say in the month of January 2022. So January 2022, credit availed, ineligible credit availed, 5 lakh rupees. Today, I realized in the month of August that it is an ineligible credit and I want to reverse it in my 3B of August month, which I will be filing in on 20th of September. The issue is whether interest is leviable on this ITC wrongly availed, given a situation wherein my balance in the cash credit ledger, is more than 5 lakh rupees continuously for last 7, 8, 9 months. So in my credit ledger, the balance is say 10 lakh rupees. January month, February up to September month, my balance is 10 lakh rupees, which is lying in my credit ledger. I availed 5 lakh rupees of ineligible credit in the month of January, and now I want to reverse it in my 3B of August month on 20th of September. Let's see what does the section says. So I am reading the amended section, the substituted section 50 subsection 3, which is applicable and effective from 1st of July 2017, where the input tax credit has been wrongly availed and utilized. So this section talks about what cases where ITC has been wrongly availed and utilized. The registered person shall pay interest on such input tax credit wrongly availed and utilized at such rate not exceeding 24% as may be notified by the government on the recommendation of the council, and the interest shall be calculated in such manner as may be prescribed. So this section 50 subsection 3 clearly says that the interest will be leviable only in a situation wherein input tax credit has been wrongly availed and utilized. Let's read rule 88B3. In case where interest is payable on the amount of input tax credit wrongly availed and utilized in accordance with subsection 3 of section 50, the interest shall be calculated on the amount of ITC wrongly availed and utilized for the period starting from the date of utilization of such wrongly availed input tax credit till the date of reversal of such credit or payment of tax at the rate notified. So 88B clearly says that the interest will start only from the date of utilization of such wrongly availed input tax credit. And when do I say that my credit is actually utilized? How do I judge whether my credit has been utilized or not? explanation to this Rule 88B says, very important, input tax credit wrongly availed shall be constituted to have been utilized when the balance in electronic cash ledger falls below the amount of input tax credit wrongly availed, and the extent of such utilization of input tax credit shall be the amount by which balance in electronic cash ledger falls below the amount of ITC wrongly availed. So till the time I am having my balance in my electronic credit ledger, it will not be deemed to be utilized. So in our example, I took 5 lakh rupees as ineligible credit in the month of January. Since my balance in the credit ledger at all given point of time is 10 lakh rupees, which is maintained in my credit ledger, this 5 lakh rupees will not be deemed to be utilized. Accordingly, at the time of reversal in my August 3B, I am not required to pay any interest. Moving on, let's twist this example. My credit balance in my ITC ledger was 10 lakh rupees in January month, February month, March month. But in April month, it reduced to 4 lakh rupees. In April month, it reduced to 4 lakh rupees, and till September month, I still have 4 lakh rupees in my credit ledger. In such a situation, when my balance got reduced in the month of April from 10 lakhs to 4 lakh rupees, then 1 lakh rupees of ITC will be deemed to be utilized. Accordingly, that date of utilization will be my April month GSTR 3B due date, and my interest will start from on this 1 lakh rupees from April month due date till August month 3B due date. So if my balance gets reduced in between, in that situation, I have to pay interest on that reduced amount. Now let's twist this example a bit more, and I will like to ask all the audience, what will be the answer in this case? So having discussed section 50, subsection 3, rule 88B, explanation to rule 88B, and few case studies related to ITC. Now the case study before us is the very same case study. January month, I took 5 lakh rupees as ineligible credit. January 2022. My balance in the ITC ledger was 10 lakh rupees. January month, February month, March month. In April month, it got reduced from 10 lakhs to 4 lakhs only in the month of April. And thereafter in May month, it again got increased to 10 lakhs. And in May, June, July, August, September, I am still having 10 lakh rupees as balance. So the issue is that I am maintaining my 10 lakh rupees of credit balance in my ITC ledger, but it is that only in the month of April, it got reduced from 10 lakhs to 4 lakhs. And again in May month, it again got increased to 10 lakh rupees, which is continuously maintained. And my ineligible credit is 5 lakh rupees, which I took in the January month. The issue is when in the April month, it got reduced from 10 lakhs to 4 lakhs, my ITC ledger balance, whether I have to pay interest on this 1 lakh rupees only for the month of April only, because in May month, it automatically got increased to 10 lakh rupees. And since then I'm maintaining 10 lakh rupees as balance, or I have to pay interest on this 1 lakh rupees from April month till August month. So whether interest on this 1 lakh rupees, since my credit balance was not maintained only for the April month period. So whether the interest on this 1 lakh rupees will be leviable only in the month of April for 1 month, or it will be levied for the entire period from April to August. I would like participants to write on the chat box, what is their view? 1 month or the entire period? Credit balance not maintained for 1 month. What should be the answer? Pradeep ji is saying 1 month. Entire period. Ankit ji is saying entire period. C. Rupa Gamaji is saying 1 month. So entire period. Nitin sir is saying entire period, 1 month. So exactly we have the ratio is 50%, 50%. Half of the audience is saying 1 month and half of the audience is saying the entire period. Let's see what does the rule says. See, when we read the explanations talked about when will that ITC will be deemed to be utilized. ITC wrongly availed shall be constituted to have been utilized when the balance in the electronic credit ledger falls below the amount of ITC wrongly availed, and the extent of such utilization shall be the amount by which amount in credit ledger falls below the amount of ITC wrongly availed. So in our example, in the month of April, it will be deemed to be utilized when my balance falls from 10 lakhs to 4 lakh rupees. 1 lakh will be deemed to be utilized as per explanation 1. Now let's see what does the rule say. Rule 88B3 says. So explanation, as per the explanation, April is the month when my balance will be deemed to be utilized to the extent of 1 lakh rupees. And what does Rule 88B sub rule 3 says? In case where interest is payable on the ITC wrongly availed and utilized, interest shall be calculated for the period. Please let us read together. For the period starting from the date of utilization of such wrongly availed input tax credit till the date of reversal of such credit or payment of tax. So the way rule is 88B is worded. It says it will start from the date of utilization of such input tax credit. In my example, it was April month. And it will go till the date of reversal of such credit. When did I actually reverse? I will be reversing this wrongly ITC availed in the month of August 3B. So the fact that my ITC increased, my ITC balance increased on account of new ITC in the month of May, June, July, it does not mean that I have reversed the credit. The way Rule 88B formula is put under sub rule 3, it simply says that from the date of utilization till the date of reversal or payment of tax. It does not say that till your balance again becomes unutilized, etc. It simply says till the date of reversal or payment of tax. And my reversal or payment of tax is happening in the month of August only. Accordingly, to my view, the interest, the way rule is drafted, the interest will be levied from April to August month and not for 1 month period. It will be for the entire period. Moving on to the next case study. Interest in case balance is lying in cash ledger. Many a times, like many of the clients ask, sir, there is a delay in filing of my GSTR 3B, but I always had some of the balance in my cash ledger. So we are talking about balance in cash ledger, not ITC ledger. Since the money is already with the government, the fact that I have filed my 3B after 4 days, 5 days, why should interest be levied even on the cash component when the balance is already there in the cash ledger? Can we argue that no interest shall be levied since I am having balance already in my cash ledger? So in this context, let's see whether, like, for example, we have a practical client there are many clients who are maintaining some cash ledger balance, etc. And there was a genuine reason for delay in returns. And they're asking, since I had a balance in cash ledger, so can we take that litigative argument, let's not pay interest because the money is already with the government, so there is no delay in payment of tax. How strong are we? So let's discuss that. Section 49(1) of the CGST Act and 49(3) of the CGST Act. Section 49 deals with payment of taxes. 49(1) says every deposit made towards tax, interest, penalty, fee, or any other amount by a person by dash mode subject to such condition shall be credited to the electronic cash ledger of such person to be maintained in such manner as may be prescribed. So 49(1) simply says that whatever you are depositing, it's only a deposit which will be credited to the cash ledger. And then when we see section 49 subsection 3 of the CGST Act, it says the amount available in the cash ledger may be used for making any payment towards tax, interest, penalty, fees, or any other amount payable under the provision of this act or rules made thereunder in such manner as may be prescribed. So 49(3) says that whatever amount you have in the cash ledger, that you can use for making any payment towards tax. And how do you pay payment towards tax? Payment of tax can be made either by DRC 03 or by filing your 3B when you are filing your 3B and depositing the tax. So the way entire section 49 is worded and the entire law is worded, the intention of the government, the policy makers since inception was that depositing money in cash ledger will not ever amount to payment of tax. The fact that you have a balance in your cash ledger, not a strong ground to argue ultimately that you have paid the tax. Similar concept was there in pre-GST regime also in excise. If we can recall the concept of PLA, people used to deposit the amount of PLA and courts have continuously held that until unless you make a debit entry in the PLA, tax will not be deemed to be paid. Accordingly, basis this judgment and the way section 49 is drafted, in my humble submission, it will be a very, very tough case to argue that no interest should be levied in case of delay in filing GSTR 3B by taking a reason that my balance in cash ledger was already maintained. So that will be a very difficult situation to argue. Hence, interest will be levied on delay in filing of GSTR 3B, irrespective of the fact that my balance is in my cash ledger. The next issue is, let's take a practical example, interest on erroneous refund. Let me give you a live example. I am a manufacturer who is supplying goods which are covered under inverted duty structure. Now, Supreme Court have specifically held that the refund of input services is not available. I can take refund only of inputs, input services not available. Practically, what has happened is that many taxpayers had filed the refund application for both inputs and input services, and they got the refund also. Now, department is issuing show cause notices to such taxpayers and asking them to surrender the refund to the extent of input services along with interest. Similarly, other situations which practically taxpayers are facing, refund of GST paid on export of goods where benefit of advance authorization has availed. So on my procurement, I availed the advance authorization benefit and I exported the goods on payment of tax. So as per the amended rule 9610, effective October 2018, I cannot export on payment of tax if I have availed the advance authorization benefit on imports. So the government department is issuing notices asking them to surrender the refund on whichever I have claimed on export of goods on payment of tax. So the issue is like in this inverted duty structure refund, if I got a show cause notice, department is saying, please surrender the refund along with interest. Since you have claimed the refund on input services and refund of input services is not available by virtue of Supreme Court judgment. And on merits, I'm not contesting the matter. I have to deposit the refund. Whether interest is automatic. So my question to like all the participants is, am I liable to pay interest? Because all these show cause notice always demand surrender the refund along with interest and penalty. So am I liable to pay interest on surrender of refund? So I want people to write, like, according to them, as per section 50, can department demand interest on erroneous refund from a taxpayer? So Ashwini ji is saying yes, Ankit ji is saying yes. So it may be any other refund which I have wrongly claimed, any other export refund. I have given just 1-2 examples. So the issue is not on this example. The issue is on the fact that I've claimed wrong refund. Now I have to surrender it back. So everybody is saying yes. So let's read the law. So this is only a food for thought. So it's only a food for thought, the interpretation which I will be discussing now. See, it's a settled proposition that interest cannot be levied in the absence of a substantive provision for levy. If we see Indian Carbons, series of judgments, etc., everywhere they have said that if you have to levy interest, then there should be a specific levy of interest in the act itself. It's a substantive provision. There cannot be a machinery provision for levy of interest. So in fact, the Supreme Court in case of Indian Carbon has held that there is no substantive provision for levying interest under the CST Act. Therefore, interest cannot be recovered from the SSC by invoking the machinery provisions of the Assam Act. And there are other GK synthetic and many other judgments wherein the proposition which has been drilled down is that there should be a levy in the act itself. Like the government should have the power to levy interest on course of in whatever scenarios they want to levy the interest. So what is happening is that we get a show cause notice for surrender of refund under section 73 or 74 along with interest. When we see section 73, which deals with issuance of show cause notice, it says, where it appears to the proper officer that any tax has not been paid. So the case one is like 73 deals with 5 situations. First, tax has not been paid or short paid. Another situation is or erroneously refunded. And next situation is where ITC has been wrongly availed or utilized. So you have not paid your output tax, or you have taken wrong refund, or you have wrongly utilized the ITC. In such situation, they can issue a show cause notice demanding this short paid tax or erroneous refund or ITC wrongly utilized along with interest payable under section 50. Now let's see section 50. In which section am I covered? And this was the agenda that in the starting, when we were taking some of the simple case studies, the objective was to read section 51 and section 53 together. Every person who is liable to pay tax in accordance with the provision of this act, but fails to pay the tax. The argument which we want to take is that under section 50 subsection 1, what is covered is only a situation wherein I am liable to pay the tax. So it means whenever I am liable to pay any tax which is due to the government, any output tax, say I have wrongly charged 12% rate instead of 5% rate, or I have not deposited tax to the government, or there is a delay in filing of 3B, etc. And section 50 subsection 3 actually covers a situation wherein ITC has been wrongly availed and utilized. So what section 50 and subsection 1 and 3 covers, wherein tax has not been paid or where ITC has been wrongly availed and utilized. The argument which we want to take is that there is no specific section to cover levy of interest in case of refund. That in case the amount is erroneously refunded, the interest will be calculated from this dash to dash. So there is no provision under section 50 specifically to levy interest on this erroneous refund. So section 50 is limited to only 2 situations. And accordingly, relying upon all these judgments of JK Synthetic Indian Carbons, an argument is possible that there is no charging provision for levy of interest in case of erroneous refund under section 50. Accordingly, any machinery provision for recovery of interest will not sustain. There is no provision for levy of interest. In the absence of provision to levy interest in case of erroneous refund, government cannot demand the refund. And in fact, in all these show cause notices, etc., whatever we are receiving related to refund recovery, etc., many taxpayers and many big corporates in India is taking this stand that no interest is payable in the absence of any legal provisions which is there in the law. But obviously, there is a high chance. Firstly, this is only an interpretation subject to what the court ultimately holds. Even though even assuming court will, even court gives a favorable decision, there is high chances that government may come out with a retrospective amendment, etc. So that's the risk which we are carrying. Moving on to the next case study. Interest in case wherein there is a delay in payment of tax to the vendor and it is not paid within 180 days from the date of invoice. So we have section 16 subsection 2 along with rule 37. Let's read this rule and then we will come to our case study. Where a recipient fails to pay to the supplier of goods or services or both, other than the supplies on which tax is payable under reverse charge, the amount towards the value of supply of goods or services along with the tax payable thereon within a period of 180 days from the date of issuance of invoice by the supplier, the amount equal to ITC availed by the recipient shall be added to his output tax liability along with interest thereon in such manner as may be prescribed. So section 16.2 says that if you don't pay payment within 180 days, the said ITC will be added to the output tax liability along with interest. And when we see rule 37, 37.3 says, the registered person shall be liable to pay interest at a rate as specified under section 50 for the period starting from the date of availing such credit till the date when such amount is added in the output tax liability. I repeat, what does rule 37.3 says? The registered person shall be liable to pay tax at a rate as specified under section 50 for the period starting from the date of availing such credit till the date when such amount is added in the output tax liability. Now, department is coming to us and saying, you have not made payment to the vendor within 180 days. Accordingly, you are liable to pay interest starting from the date of availing such credit. Say invoice date was 1st April 2022. I did not make the payment by 30th of September. And accordingly, department is coming and saying that since you have not paid the payment within 180 days from the date of invoice, please pay interest from the date of availing the credit. That is April month credit must be taken in April month 3B, which is filed on 20th of May. So please pay interest from 21st of May. So now, is this contention of the department correct? Am I liable to pay interest from 21st of May if I have not made the payment within 180 days? Payment has not been made within 180 days. Am I liable to pay the interest from the date of availment? That is 21st of May. If department is contesting. So I would like to ask participants, Is department correct in contesting and arguing that please pay interest from 21st of May? You all can write on the chat box. So let's make this interesting. Payment not made within 180 days. Department is coming, invoking section 16 subsection 2 and saying, as per rule 37 sub rule 3, please pay interest. So Arunji is saying yes, that too from 21st of May. Pradeep Shahji Singh. Devinder ji is asking what I have minimum ITC balance with me. That's the next question. That's a twist to this question. I have minimum balance maintained with me. But what does this rule 37.3 saying? Does it say pay interest from the date of utilization? We have a specific rule for this. Payment from the date of utilization is only mentioned in section 50 subsection 3 and rule 88b3. It is not mentioned in rule 37 sub rule 3. Rule 37 sub rule 3 only says pay interest from the date of availment of such balance without considering the fact that I have any balance maintained. So these are some of the questions. Now let's drill down various interpretations which are available to us and which generally various industry players are taking. Some of the interpretation. So one of first interpretation. See, if you have to contest this matter, department will come and ask interest from 21st of May only. They say you have not paid payment within 180 days. Please pay interest as per rule 37 sub rule 3. And people have got notices also. And the way we are drafting the show cause reply, etc., and what grounds we are taking. Multiple grounds, different grounds. Let's discuss each of the interpretation which is available, and let's see what is the correct interpretation together. The first interpretation is government does not have the power to levy interest under section 16(2) read with rule 37. I repeat, the first interpretation is that government does not have the power to levy interest under section 16(2) read with rule 37 sub rule 3. And the reason for this is that when we see section 16 subsection 2, it says that if I have not made the payment within 80 days from the date of issuance of invoice, the amount equal to ITC availed by the recipient shall be added to his output tax liability, along with interest in such manner as may be prescribed. And how it will be added in the output tax liability? It says the amount has to be added in form GSTR 2. And when we practically say, if you see and you read this entire rule 37, it says that this has to be added to your output tax liability and it has to be added in your GSTR form GSTR 2. Friends, if you recall, if you see GSTR 2 format, in GSTR 2 format, there was a specific table for mentioning this kind of amount, wherein you have not made the payment within 180 days, and GSTR 2 format would have created your output tax liability. The first interpretation which is possible is that since my entire system of GSTR 1, 2, 3 is kept in abeyance because of technical glitches, and what is there today is only GSTR 1 and 3B, and in 1 and 3B we only have two tables, output table and input table, and in output table I don't have any column to record this addition of in my output type liability on account of non-payment within 180 days. Since there is no system of GSTR 1, 2, 3 which is implemented in India, it's only GSTR 1 and 3B which is being implemented. Accordingly, section 16(2) read with rule 37 cannot be deemed to be implemented and interest is not payable. When my rule 37 specifically says interest has to be paid till the date such amount is added in the output tax liability, and there is no mechanism to add it in the output tax liability. Accordingly, no interest should be levied because rule 37 cannot be implemented in the absence of the procedure prescribed under the rules. Rules itself is not implementable, hence interest not leviable. First argument. Second, you say, sir, this argument is very dangerous. It's some of you may say it's far-fetched. So this is highly debatable argument, etc. So let's now move to the second argument, which is the governing section for levy of interest under rule 37(3). As we discussed, interest is a substantive provision. It has to be levied under the act. Rules cannot levy the interest. Rules at best can only provide limited details on the mechanism of how the interest has to be levied. So what is the governing section for levy of interest, whether it is section 16 or section 50 subsection 3? Let's see both the possibilities. We say rules 37(3), which is a delegation legislature, it gets its existence from section 16 subsection 2 because in this itself it was written along with interest. So let's read section 16 subsection 2 together. Where a recipient fails to make payment to the supplier within 180 days from the date of issuance of invoice, the amount equal to the ITC availed by the recipient shall be added to his output tax liability along with interest thereon in such manner as may be prescribed. So the way section 16 subsection 2 is worded, it simply says that this ITC has to be added to the output tax liability, comma, along with interest thereon, comma, in such manner as may be prescribed. And the way this section is worded, in such manner as may be prescribed, has to be read to with output tax liability. What will be the mechanism to add it to the output tax liability, which is prescribed under Rule 37, that it has to be through GSTR 2B. So the argument which we want to take is that if we say that Rule 37(3) is brought under section 16 sub rule 2 and the charging section for levy of interest is section 16(2), then section 16(2) itself is not sufficient to levy an interest the way it is drafted. It should have been drafted in a manner the way section 50 is drafted. When we see section 50 subsection 1 subsection 3, the way a proper interest provision is drafted, and since interest being a substantiated provision, section 16(2) not being properly drafted, no interest can be levied. Second argument. Third, we say the governing section is section 50 subsection 3 only. Section 50 subsection 3 is very wide. It includes ITC wrongly availed and utilized. It simply says where ITC is wrongly availed and utilized, then interest will be payable from the date of utilization. So in that situation, if we say the governing section is section 50 subsection 3, then Rule 37 is contradictory to the extent it says interest will start from the date of availing such credit. If I have not utilized this credit, when section on itself talks about that interest has to be paid only if the credit is availed and utilized, then the rule cannot go beyond what is there in the section. And accordingly, we can argue that if I have the balance which is maintained by me, in that situation, no interest will be levied. So these are the various possible arguments which might be taken, which can be taken to argue that interest is not leviable if I have, or to argue that if I have my balance which is there with me. In that situation, Rule 37(3) should not be interpreted strictly, and it should be governed by what is there in section 50 subsection 3, and until unless I utilize it, interest cannot be levied. Let's move to the next case study on interest on ineligible transitional credit. Friends, these days department is doing so many scrutiny for the transitional credit taken by the taxpayers, and they are issuing notices for demanding and recovering this wrongly transitional credit which the taxpayers have carried forward along with interest, etc. So let me take a case study. The issue is, in my service tax return, certificate credit was 20 lakh rupees, which I could have carried forward under section 140 subsection 1. By mistake, I carried forward 25 lakhs. So I filed my transitional form, and by mistake, I carried forward the credit of 25 lakhs. Now, government has issued me a notice to demand 5 lakh rupees of this transitional credit along with interest. My question to the audience and all the participants is whether government has the power to levy interest on ineligible transitional credit. So what is your view? Whether government has the power to levy interest on ineligible transitional credit. If I receive a show cause notice on they demand tax recovery of ineligible transitional credit, can they So Nitin ji is saying yes. And what about other participants? Ashwini ji is saying yes, yes. If utilized, no, if not utilized. See Dilip ji. Arup ji is also saying yes. So whosoever is saying yes, under which section? Say which is the section to levy interest? in case of ineligible transitional credit. Under which section? Nitin ji saying 174. And any other view? See, let's now again section 1. Let's go to section 140. What does section 140 says? A registered person other than a person, say I'm just taking one example. I wrongly carried forward this grade. A registered person other than a person opting to pay tax under section 10 shall be entitled to take in his electronic credit ledger the amount of standard credit of eligible duties carried forward in the return relating to the period ending with the day immediately preceding the appointed date furnished by him under the existing law. So what does section 140 says is that I can carry forward the amount of standard credit of eligible duties. So the wording used is amount of standard credit of the eligible duties. I carried forward. Now, what does government is doing? Government is issuing notices under section 73 and 74. And why they are issuing under 73, 74? They are relying upon rule 121. And what does rule 121 says? It says the amount credited under sub-rule 3 of rule 117. This rule 117 talks about availment of transitional credit may be verified and proceedings under section 73 or as the case may be under section 74 shall be initiated in respect of any credit wrongly availed, whether wholly or partly. So rule 121 says that the proceedings can be initiated under section 73 or 74. So they can initiate the proceeding under section 73 and 74 for the transitional credit. Again, let's go to section 73, which we read. Where it appears to the proper officer that any tax has not been paid or short paid or erroneously refunded, or where ITC has been wrongly availed or utilized, then in such situations, they can issue a notice along with the interest payable thereon under section 50. The words used under section 70 is that along with the interest payable thereon under section 50. Now let's again go to section 50. So 121 gives power to start the proceedings as per section 73 and 74. So they are issuing notices under 73 or 74 relying upon rule 121. And 73 says that they can demand the tax along with interest, whatever interest is payable under section 50. So section 73 is not creating a levy of interest. Please note, 73 is not creating a levy of interest. It only says what is payable under section 50. Let's again go to section 50. Section 50 talks about only two situations. First, where output tax is not paid. Second is where ITC has been wrongly availed and utilized. What do you mean by ITC? Section 50 subsection 3 talks about ITC has been wrongly availed and utilized. So let's see what is ITC. ITC means credit of input tax. Input tax means in relation to a registered person means the central tax, state tax, integrated tax or union tax charged on any supply of goods or services or both made to him and includes tax payable under reverse charge on import of goods, blah, blah, blah. So it all talks about whatever GST I have paid either under reverse charge or on import or to the supplier, etc. Input tax credit definition does not include this amount of standard credit of eligible duties which I have carried forward. There is no section under section 140 read with rule 117 and corresponding rules which says that the amount of standard credit of eligible duties will be deemed to be input tax credit for the purpose of this act. It nowhere says that it will be deemed to be input tax credit for the purpose of this act. Accordingly, our view is that there is no section, the section 50 does not cover the provision to levy interest on transitional credit. Transitional credit means amount of standard credit which is carried forward, and hence transitional standard credit is not an input tax credit as per the definition of input tax credit. Accordingly, even this retrospective amendment of section 50 subsection 3, which provides for recovery of interest only in case of input tax credit and not wrongly transitional credit, will not be applicable, and hence there is no power to levy interest. And apart from that, the other argument itself, which I'm not discussing for in today's seminar, otherwise the general argument which we otherwise is also taking that they cannot even proceed to recover the transitional credit under section 73 because rule 121 is beyond the scope of main legislation. The provision of rule 121 of the CGST rules are ultra vires the provision of the main act, It is the established law that the delegated legislation cannot travel beyond the scope of the main legislation, and they should have created this provision under the act itself to recover the input tax credit. And even when we talk about section 174 repeal and saving act, that is applicable only to the extent if they want to issue a service tax notices, etc., and they want to create a demand under the service tax regime stating that what I have taken in service tax return is wrong. But when I'm carrying forward in GST regime, and then in such a situation, government is recovering the tax under 73 and 74 of the GST Act, and under 73 and 74 interest is payable only that much. 73 74 does not itself create the levy of interest. It only says along with interest payable under section 50, and in section 50 itself, and section 50 itself does not include the levy of interest on transitional credit. So even like somebody may say logically transitional credit should be seen akin to input tax credit, etc. That may be a logic, but not in the law. We have to read the law strictly, specifically when it comes to the interest provision. So whatever I am discussing, see, for like appreciating whatever arguments we have been discussing for the past 40 minutes, etc., we need to read all these judgments. Indian Carbon Limited, etc., all these judgments, etc., which drill down into how an interest provision is a substantive provision and the way how it has to be drafted. And the way law is drafted, you don't have a provision to recover transitional credit. You don't have a provision to levy interest on transitional credit, to my view. Moving on to the next case study relating to wrong nature of tax. So many times we see, I was supposed to pay CGST and SGST. However, by mistake, I paid IGST. Now I have to pay the correct tax and take the refund of the wrong tax paid. So we have section 77 of the CGST Act and section 19 of the IGST Act. In both cases, the law is clear that whenever you're paying the correct tax and taking refund of the wrong tax, you are not required to pay any interest on the amount of amount of tax which you have not paid. So section 77 and 19 of the IGST Act specifically gives reliefs. So 77 says a registered person who has paid integrated tax on a transaction considered by him to be an interstate supply, but which is subsequently held to be an interstate supply, shall not be required to pay any interest on the amount of central tax or state tax, as the case may be. Similarly, we have the similar section 19, wherein a registered person who has paid CGST and SGST, as the case may be, on a transaction considered by him to be an interstate supply, which is subsequently held to be an interstate supply, shall not be required to pay interest on such amount of IGST. So section 17, 19, clearly no interest payable. Moving on to the next case study. Interest in case of reversal of common ITC. So under section 17, the law says that if I'm providing taxable turnover, like I'm executing taxable as well as exempted turnover, then whatever common credit I'm availing, I have to take proportionate credit. I have to reverse it on, and then rule 42 and 43 provides a complete mechanism of reversal of credit. How do you have to reverse the credit? There are two different formulas. One is generally based on the turnover, and for real estate, it is based on the area. So let me give you an example to appreciate this case study. I'm a real estate player. I launched my project in 2017, first in July 2017. It got completed in January 2022. I received the occupation certificate in January 2022. At that time, my 60% units were sold, 40% units were unsold. 60% units were sold, 40% units were unsold. The issue is, the law says I have to reverse the input tax credit. So January I received OC, I have to reverse the input tax credit based on the unsold area, which is 40%. If I don't reverse in January month, I reverse it, say later on in September 2020. So I reverse that amount in September 2022. And I have not reversed it in January month when I received the OC. Whether interest is payable, then section rule 42 itself says when this liability of interest will start. It says they shall be liable to pay the interest on the said excess amount at the rate specified for the period starting from the first day of April of the succeeding financial year till the date of the payment. So the rule itself says that I have to pay this interest from 1st of April till the date of payment of tax. So there is a mechanism of reversal of credit under Rule 42, 43 for a normal taxpayer as well as real estate taxpayer, wherein I have to reverse on account of unsold units in a real estate project or on account of exempted turnover in a general taxpayer's books. So interest as per section 42 and 43 will be levied only from 1st day of April of the succeeding financial year. In our example, 1st April. Now the issue is, suppose I have my balance which is being maintained. I was supposed to reverse the credit from the 1st day of April. See, I have not reversed on 1st day of April. So interest meter will start as per Rule 42. If we see the provision, interest meter will start from 1st day of April. But I have the balance which is maintained by me. In that situation, can I argue that since I have not utilized the credit, and in spite of the fact that I am reversing it after 1st April, say I'm reversing it in the month of May, June, July, etc., no interest will be paid till the time I have the balance in my credit ledger? To my mind, the answer is yes, because again, when we see Rule 42, it only, again, when we said a rule itself cannot create a section, cannot create a charge for levy of interest. It has to come from the Act. And in Act, we only have section 50, subsection 3. In Act, we only have section 50, subsection 3, which says that interest will be levied only in case of ITC wrongly availed and utilized. So the situation covered is wrongly availed and utilized. And since I have not utilized the credit, my balance is being maintained throughout. Accordingly, to my mind, the interest meter will start from 1st April or date of utilization, whichever is later. So this Rule 42 to sub Rule A has to be read to mean that date of interest will start from 1st April or date of utilization, whichever is later. Moving on to the next case study, I will be taking all the question and answers in the end. So the case studies which we discussed was the cases wherein department is recovering and demanding interest from us. Now let's discuss few of the case studies wherein I go to the department and ask for refund. Though practically it's not easy to get refund. You'd never get refund so easily. Let's read what's there in the section. Section 56 deals with interest on delayed refunds. Very important case study. Let's read together. Because I will take one example. It's a very live example which we are facing in many taxpayers. Department is taking totally a different position. Let's see what does section says, and let's apply that section to this case study which we will discuss. Interest on delayed refunds. If any tax order to be refunded under section 5 of section 54 to an applicant is not refunded within 60 days from the date of receipt of application under subsection 1 of that section, interest at such rate not exceeding 6% shall be payable in respect of such refund from the date, please note, immediately after expiry of 60 days from the date of receipt of application till the date of refund of such tax. So this section says that if I have given an application for refund and department is not sanctioning the refund within 60 days, and say they sanction it after 90 days, after 120 days, then I will get the refund along with interest, and that interest will start from expiry of 60 days from the receipt of application. So as soon as that 60 days expire from the receipt of application, interest meter will be triggered and department will have to pay interest from 61st day till the date of refund. This is what the main section says. And then we have a proviso. So proviso deals with a situation wherein, say, refund is rejected by the authorities, you go to appeal, and in appeal you win the case. And when you win the case in appeal, you have to again apply for a refund application. So generally what is the process is that you applied for refund. If refund got sanctioned, good enough, you are covered under the main section. In main section, if refund is given within 60 days of the date of application, good enough. Otherwise, after expiry of 60 days from the date of application, you are eligible to take the interest. Now let's take a second scenario. Provided that where the second scenario is that I applied for refund, I made an application, the application got rejected. Thereafter, I moved to the first appellate authority, I filed an appeal. It took 3, 4, 5 months, hearing came, finally I won the appeal. After winning the appeal, I don't get the refund automatically. The circular says, there is a specific circular on this. It says you have to again file a refund application citing the appeal order, etc. Pursuant to this order, appeal order, you have to again file a refund application. So I again filed a refund application, and thereafter government took 90 days to give me the refund. So that's the second scenario. Now let's read proviso. Provided that where any claim of refund arises from an order passed by an adjudicating authority or an appellate authority or an appellate tribunal which has attained finality, and the same is not, please note, and the same is not refunded within 60 days from the date of receipt of application filed consequent to such order. So the example which we took is that I won in commissioner appeals, thereafter I filed a fresh application and it is not received within 60 days from the receipt of this fresh application. Interest at such rate not exceeding 9% will be payable after expiry of 60 days from the date of receipt of application till the date of refund. So my proviso says that 9% interest will be applicable in this scenario. After reading this section, let's go to our case study. And it's like on this case study itself, we have dealt many matters on this case study itself. Like it's a very hot topic which we are dealing on daily basis these days. My refund application date was 1st April 2022. It got rejected. I went to appeal and I won the appeal, and the appellate order came on 1st September 2022. So commissioner appeal favorable order came on 1st September 2022. Then after this order, I again filed a fresh application consequent to this order on 1st October 2022. And government gave me the refund on 31st January 2023. This is the scenario. This is the fact. What department is saying is that since we are covered under proviso, they are saying that since it's a matter of adjudication, we are covered under proviso, and in case we are covered under proviso, accordingly, the refund will be given only after the expiry of 60 days from the receipt of the fresh application. So in our example, the fresh application, original application was 1st April 2022, which got rejected. I went to the commissioner appeal. Commissioner appeal gave favorable order on 1st September 2022. Then again, I filed my fresh application of 1st October 2022. What department is saying? Our case is covered under fresh application, proviso to the section 50C. Accordingly, 60 days. Accordingly, after expiry of 60 days from the fresh application, my fresh application was 1st October 2022. 60 days got expired on 30th November 2022. Accordingly, my interest will be payable at the rate of 9% from 1st December 2022 till 31st January 2023. At 9% for these 2 months. That is the only interest which is payable to you. You will not get any interest for the past period. For the past period, no interest is payable. Your interest is, since we are covered under the proviso, you get interest only for from 1st December 2022 to 31st January 2023. Is this understanding of the department correct? Are they correct? So refunds which we actually get after commissioner appeals, etc., and then we file a fresh application, and from fresh application 60 days have passed and they levy give the interest from 61st day as per the proviso. Nilesh Ji is saying no. Any other view? Ashwin Ji is also saying no. Same is our view also. So in fact, they have totally misinterpreted this proviso. They are saying that if you are covered under adjudication or appellate authority order and you are taking refund pursuant to an order, then interest will be as per proviso. Otherwise, if you are getting direct refund without any litigation, then you are covered under the main clause. This is not the way this section is drafted. It's a proviso to the main section. And in fact, the current interpretation is that it is in the nature of penal interest, 9%, more of a penal interest, that originally I will be governed by main section itself, that whatever interest is payable, that is payable to me at the rate of 6%. That is, my interest will start from expiry of 60 days from the date of original application. My original application was 1/4/2020. Since 60 days expired on 31st May. So my 61st day will start from 1st June 2022. So I will get interest at the rate of 6% from 1st 6 2022 itself. However, if they have not given my refund, even after winning the case and giving a fresh application and 60 days have passed, pursuant to giving the fresh application, my interest will become from 6% to 9%. And accordingly, in our example, from 1st June till 30th of November, I will get interest at the rate of 6%. And for the remaining period at the rate of 9%. The interpretation given by the department at various places is incorrect, that I'm only eligible to get the refund under the B category and not the A category. Moving on. Another issue is not issue, just a section which I want to bring to the notice of all of you is that interest on refund of amount paid for admissible of appeal. So whenever you are going for an appeal, first appellate authority, I have to pay 10% of pre-deposit. And in tribunals, though tribunals have not formed, 20% of the tax amount. So 10% at appellate stage, and at tribunal stage, it's 20%. And down the line, I win the case, and this amount has to be refunded to me. Then I am eligible to get the refund on this interest on this amount, which is refunded to me. It will be from the date of payment till the date of refund of such amount. So we have a specific section for interest on pre-deposit, which is refunded to me, and that amount which I pay for admission of appeal, that is 10% or 20%, as the case may be. So we have a specific section for interest on pre-deposit also. So with this, I will end my presentation, and now we'll move forward for question and answer.
Tushar, extremely enlightening session covering the various facets of the interesting aspects of the interest.
So I really don't know whether actually many issues involve lots of interpretational arguments, which is yet to be decided by the court. And everybody can have its own view, and these all interpretational issues has to be actually decided by the court. But this is something which we are doing on presently, the way we are executing and making replies to the show cause notice, trying to argue interest cannot be levied for refund, interest cannot be levied for transitional credit, etc., all these technical grounds.
It is a delicious food for thought for everybody here. Now I request Saurabh to take up the question and answers.
Sure, sir. So Tusharji, first question in the chat box is, how to handle a situation wherein an assessee not wanting harassment paid the amount demanded of ITC as difference in 2A versus 3B, but post that payment the department is now coming after interest under section 50 for the above transaction as delay in the payment of due tax from the date of utilization of excess ITC till the date of payment of tax.
Okay. So the issue is they have reversed the input tax credit pursuant to a demand for 2A 3B difference, and now department is coming and asking interest also on this over and above 2A 3B demand. So that's the issue. So the way we are handling, and it's a very, very common issue, like everybody is facing, every taxpayer, every professional, everybody. See, the best way to argue in this case is, you cannot challenge the levy of interest on this scenario. See, practically, you cannot say that under section 50 it does not have the power to claim to levy interest for ineligible and wrongly availed and utilized ITC. Because so the best way to deal in such situation is, you have to per se argue that they cannot demand the ITC in case of 2A 3B difference. It is only a post 1st January 2022 that the law has been amended, and in the act itself they have added a condition that the supplier should upload the invoice, which should get auto-populated in my 2B, etc. Prior to that, till the time I am satisfying all the conditions, we have to move on to deadlines to argue that 2A 3B demand cannot be sustained. Since demand cannot be sustained, interest cannot be sustained, and accordingly penalty cannot be sustained. And for demand for 2A 3B, all the general arguments which we are taking, relying upon rights are LGW, etc. The way section 16(2)(c) is drafted, it is entirely based on section 41, 42, 43A, which is not yet implemented in India. That was based on 1, 2, 3 old filing system. So all those legal arguments, etc., we have to challenge 2A 3 demand per se in the notice, and accordingly say, since demand is not payable, interest will not be levied.
So next question is, how to handle a situation where assessee has received service tax notice based on income tax returns.
See, again, there are various judgments to this also, and whenever they are receiving, you are receiving any service tax notice based on an income tax returns, etc., you have to show and firstly tell them that how is not a service. The amount which I have showed in my income tax return does not amount to service, and apart from that, there are multiple high court judgment which says that you cannot simply take these reconciliations and demand and impose tax. There should be a proper show cause notice by the department. They should make an allegation under which service I am covered, what services I have provided, and that show cause itself should be elaborate. So again, there are multiple grounds when you talk about this particular situation. First is the way show cause is drafted. We have to challenge the show cause itself, the way it is drafted. The allegations are not clear. Second, we have to prove ourselves that whatever there is in the income, that is not pursuant to any services which are uncovered under the service tax. Third, relying upon various judgments that you cannot take this reconciliation as a base to issue the notice.
Devendra Singh Nagpalji has written a query. Will it make the difference if we pay tax but do not claim refund of other taxes? And this is under, I think, section 77 related.
In the respect of section 77 and section 19, see, the law says if you pay the tax, you need not pay the interest. The fact that you are not claiming refund, no harm to the government. So no interest will be levied.
Kavya has asked for reversal under Rule 4243. If we reverse in March TB return, which is filed on 20th April, whether interest is payable since it is not reversed on 1st April in electronic credit ledger.
So for reversal, and so when we talk about this 4243 reversal, it says that if you have not reversed the credit, then interest shall be levied from 1st of April. So my reversal will be deemed to be done on 20th of April only. See, even though I am doing it for March period, it will be deemed to be done on 20th of April only. So it will create an interpretational issue. Hence, we are always asking our client to better reverse it, reverse to the maximum extent under in February month return, or else paid through DRC 03 on 31st March to avoid any litigation.
Sheshgiri Joshi ji is asking, is interest payable on late payment of RCM?
Yes, late interest is payable on late payment of RCM under section 50 subsection 1. When we see output tax definition, etc., and various sections, RCM is specifically covered under section 50 subsection 1. So interest will be payable.
Okay. Mr. K.R. Prakash is saying, when government gives interest at 6% after expiry of due date, we expects 18% interest, which is very high. No financial institutions offer. Can we request to reduce rate of interest?
Sir, I think Nitin is the best person, and we can all request him to let's like CGPI, we all together with CGPI file this application to have some parity. So obviously the point is very, very genuine. If I make a default, I have to pay 18%. You make a default 6%. No comparison, 18 versus 6. So issue is genuine, but this has been the trend till now in indirect tax litigation and indirect tax losses across India, across various laws, etc.
One question. Can you just throw upon some light about the 18% and 24%? Because the department demands 24%.
Yes, sir.
We want to pay 18%.
Yes, sir. Yes, sir. So firstly, I will just take you to this background that like by this 24% came into picture in the act itself. So when the initial draft law was being made, at that time, when the law committee was meeting, see, they had imposed actually 2 rates in case of wrong ITC. They wanted to propose. One is 18%, second is 24%. I will tell you what was the situation which was contemplated for 18%, what was the situation which was contemplated for 24%. When we see, and for this, like we have to see section 50 subsection 3, which was previous to the substitution, which was before the substitution. So at that time, the intention of the government was that 18% interest will be applicable in case of general mismatch or in case of ineligible credit, 42, 43 reversals, all scenarios. However, 24% was applicable only in a situation of section 42.10 and 42.11 miscompliance. Because if you see previously section 50 subsection 3, that referred to the wrong ITC as per section 42.10. And 42.10 dealt with the situation wherein that was a case wherein you have done a mistake twice. So what was the example was that you had taken a mismatch. There was a mismatch of credit. You had reversed the credit, and then you again took that credit sumuto, and then again department is asking you to reverse it. So 42.10 was for a situation wherein 1, 2, 3, there was a system of GSR 1, 2, 3 at that time that was emphasized. the taxpayer was required to reverse the credit immediately if that was not matching. And if after reversal, he takes the credit sumutu and again, he has to reverse the same. So he makes the same mistake twice. For that, they had incorporated that 24%. And so that was there at that time for 24% was for that situation only. Now, what happened is that at ground level, many officers says ITC wrongly availed, wrongly utilized, whatever is the situation, it's 24%. The answer is clear cut. Today in India, the law is very clear that it is only 18% which is applicable, not 24%. And in fact, lately in last couple of months, I've seen, at least in Gurgaon, Delhi, people now officers are, DGI is accepting 18%, NT-Vision is accepting 18%, many jurisdiction and departmental authority people are also accepting 18%. Now they have started to accept. Otherwise, before that, everybody was on 24%. So there is no 24% tax which is there.
So if we have paid at 24%, can we file a refund application for the difference of 6% today?
Absolutely, sir. That is your right. But whether you will get the refund or not, I cannot commit.
That is $1 million question. Anyway, thanks for the clarification.
So if any participant has any further doubt, so kindly quickly post in the chat box.
I think there is one more question by Ashwinji, is that government is compelling traders and putting condition that if payment is not received within 180 days, one should reverse and ignoring the terms and conditions between the trading community. So that's again a very genuine question that everybody is asking, that if you have not made the payment within 180 days, government is asking us to reverse the credit along with interest, etc. There are cases wherein my terms itself is not for more than 180 days. All your capital goods procurement terms generally, which see if you procure hundreds and hundred crores of capital goods, terms are 50% will be paid now, 30% later, 10% later. It is stretched over 1 year. So first is the legal argument itself that there is no failure to make the payment because my contract itself said that I have to pay within 1 year. So there is no failure to make the payment. That is the larger argument available. Apart from that, your concern that how can government put such kind of restriction? The issue is, can I constitutionally challenge this restriction? See, first of all, Senate credit is not your vested right. Let's be very clear. Senate credit is not your vested right. Even if we go to the excise regime, in excise regime, Modvet started from 1986. No capital goods credit was given. Capital goods credit got introduced from 1994. So it's not your vested right that you can demand that I have to get Senate credit. So if they are giving Senate credit, if they are giving input tax credit benefit to you, then in such situation, they can always impose condition. But obviously that condition should be reasonable. So when they talk about a condition that there should be documentary evidence, it's a reasonable condition. You have received the goods, reasonable condition. But made payment to the supplier within 180 days. Had it been that you should have paid the tax amount to the supplier or the supplier should have deposited the tax, when that condition itself is there, that supplier is paying the tax, then only you are getting the credit. The law is very clear now after 1 January 2022, until unless the supplier pays the tax, it is auto-populated in your 2B, you don't get the credit. So government is getting the GST amount. So why there is a need to put this restriction on the basic amount to pay? Can we say it is arbitrary? So that is something which has to be challenged. I would not say that it's a good case or it's a bad case. It has to be challenged and let's see what the court holds. But again, at least it merits challenging this condition.
So in that case, let us do the documentation saying that I am remitting the money towards the tax. So will I circumvent the rule 37 in that case? I don't pay anything. Principal component I don't pay. I pay only tax.
So that's what practically many people are doing. But the way this section read with rule is written, it says pays the basic value along with tax. So department always says pays the basic value along with tax. So now there is a tribunal judgment in the case of Hindustan Zinc also in the context of service tax regime, Senate credit regime. There also we had a condition you have to make the payment within 3 months. So there they said that once the tax has been paid, accordingly the credit should be allowed. So Nitin sir, the idea which you are giving is that at least on records I should make payment to the tax. It will definitely add strength to my case. Department will not agree, but if I litigate, it will add a strength to my case.
They are asking for the proportionate reversal in that case. That is the reality. That is the audit issues.
Absolutely, absolutely.
Deepak Thakkar sir has asked, date of payment amount paid in electronic cash ledger is deemed as date of credit to the government account as per explanation to section 49. So your views, please.
See, this section explanation only says date of credit to the account of the government in the authorized bank shall be deemed to be the date of deposited in the electronic cash ledger. So it only says that this amount which I am paying is an amount which is lying in the, which will get deposited in the cash ledger. So this amount which is credited in the account of the government shall be deemed to be the date of deposit in the credit ledger. So when the amount is received in the bank account of the government, the challan, whenever I'm depositing that challan, whenever the government receives that amount, that will be the date it will be deemed to be deposited in the credit ledger, cash ledger, electronic cash ledger. It does not mean that government has got the tax component of it. See, tax payment is only when I make a debit entry from the cash ledger, and that is the way entire section 49 is drafted. And at that time only, see, if I have deposited the IGST, the government does not know which is the place of supply for this underlying IGST. The settlement will not happen. It's still there at the cash ledger. When you file your return, you make a debit entry in your GST1. You write, this is my IGST supply, this is my place of supply, etc., etc. Then government knows your entire details, and accordingly, the bifurcation of CGST and SGST happens. The state portion goes to the state. So the intention of the lawmaker is very, very clear. Deposit in cash ledger cannot be deemed to be the payment of tax.
Okay, Tusharji. So I think we are done with the queries. So now I would like to propose a official vote of thanks to our learned speaker, Shri Tusharji. So our learned faculty, respected Shri Tushar Aggarwal and all the distinguished participants who have joined from across the nation. It's my privilege to propose a vote of thanks for such an important deliberation on the omnipresent issue, I would say, in the tax world, which is levying interest by the revenue authorities. So wherever there is a tax demand, there is interest and there is penalty. So I, on behalf of all the members of CGPI family, extend a very hearty vote of thanks to our own learned speaker, Shri Tushar Aggarwal for taking out his valuable time to share his knowledge on the interplay of various legal provisions relating to the levy of interest in various cases. I especially like the way Shri Tusharji has gone deep into decoding, I would say, the semantics of the legal provisions and clarifying the correct mechanism of computing interest. The way Tusharji has trained a long line of 12 case studies on one single topic of interest. I trust no practical scenario has been missed from the deliberation. He has very well discussed the relevant court rulings, both favorable and unfavorable, to the taxpayers throughout his case studies. The way he has given a probable future of various litigative issues in the light of current jurisprudence and possibility of bringing in pro-revenue amendments in the law by the government, as we used to see, is also very helpful in giving a pragmatic view of the issues to our clients in our day-to-day practice. Also, the legislative intent while framing of law around 18% and 24%, since Tushar has been closely working with the government officials, so it is really a topping on the cake for all of us. And it has been really a very comprehensive session. The way he has practically and comprehensively delivered on this topic of interest is really exemplary, and it has been a session of everlasting utility for all the tax professionals, and it shall be in our library, I think. So, Tushar with this, we convey our deep sense of appreciation for your work.
Thank you so much. Thank you, Nitin Bhai. Thank you, Arup sir, Saurabh Bhai, everyone for this opportunity. It was actually a pleasure to speak on this topic and interact with all the participants, knows the various views which is being faced, which is being by the participants, etc. So it was, and like in chat box, many people are talking about sharing the PPT. So, sir, I will also be sharing the PPT shortly.
No problem. Thanks.
Also, I would like to extend a special thanks to all the participants for joining in and making the session lively and more enriching with their practical queries. Last but not the least, as no program can become successful by any single person, so I extend my big thanks to the entire CGPI team working relentlessly in the background to organize such thoughtful deliberations with learned faculties on burning issues faced under the GST law and practice. Thank you so much, everyone. Thank you.
Thank you.
Thank you.
With this, we conclude the meeting. Thank you.
Thank you.
Thank you.